Nigerian banks borrowing from the Central Bank of Nigeria surged to 24 trillion naira in just the first 3 months of 2024. This reliance on the CBN standing lending facility window comes at a high cost, with interest rates exceeding 23%. Furthermore, the CBN has penalized banks for failing to meet cash reserve requirements. Tajuddin Ibrahim, Director Research and Strategy, Chapel Hill Denham Securities, joins me for more on this. Good morning, Tajuddin. Good to have you join us today.
Good morning. Thank you for having me on the show.
All right. Nigerian banks have borrowed 24 trillion naira from the central bank in just 3 months of 2024. And this was about the same amount it borrowed within the first 11 months of 2021. Is this illiquidity staring us in the face or something else?
So definitely it is a reflection of liquidity challenges in the banking sector, because if you look at that number, it reflects the fact that the banks have been going to the CBN's standing lending facility window. And you see banks going to that window when there are liquidity issues with the banks. You will see them go to the window to borrow from the CBN just so that they are able to meet their own financial obligations as well. So it is a reflection of tight liquidity condition in the financial system, particularly in the banking sector.
Well, now that you've said that, some have said the monetary policies of the CBN, whether it's the MPC, the CRR, or even its drive to keep the Nigerian naira stable, have contributed to these. What are your thoughts? Is that what the case is?
So that exactly is the case. If you look at the CRR as we speak, the cash requirement, cash reserve ratio of the banks is 45%, and that is coming from previously 32.5%. And also, if you look at the interest rate environment, we have a situation where the monetary policy rate is 22.75%, and that number is up from around 18.75% level. So what that indicates is that the CBN is looking to mop up excess liquidity in the financial system by raising the CRR to 45%. Bear in mind, the 45% cash reserve ratio in the banking sector in Nigeria is the highest among the 20 economies that we track globally at Chapel Hill Denham. So one would expect that the impact is enormous. The impact is significant on the liquidity conditions in the banking sector. So those that allude to that are spot on in that regard.
All right, talking about the CRR, there are those who would say that, okay, let's look at the guideline the CBN released on CRR, that what it said was that its deduction will not be the same method, that was used before now. What's the difference, really?
So the difference is that it allows some flexibility. And by flexibility, I mean, the previous method was a lot, more stringent than the current method. So the current method allows, for liquidity to be examined on a weekly basis, and you will be debited, on your excess CRR, on your excess liquidity only based on the increase in your deposits on a weekly basis. So that is, a less stringent method, and it should allow the banks to have at least, some money to be able to lend out to the public. But the reality is that, they still, get to take away the excess, from them in terms of, CRR.
All right, so what does this portend for, the financial sector, really, and even the economy? A situation where banks do not have money. I mean, I'm just wondering, I'm thinking, how will they, fulfill their financial intermediation role or even some other things in that regard?
So obviously, it is a challenging period, and we just have to be honest in this regard. It is a challenging period for the country. It's a challenging period for the banking sector. We should, focus on the larger picture. And the larger picture in this regard is the fact that we need to maintain a tight monetary policy, stance, because we need to let inflation moderate. inflation at well over 31% is way too high. And the 31.7% inflation we are talking about is the second highest since 1996. The highest that we have seen in this economy was in 1996 in January when inflation was well over 40%. So there is need to maintain a tight monetary policy to rein in inflation.
Let me come
And
in
in
here.
doing that,
Let me come in here. Okay, so I think you should just continue. I bet you're about to say, maybe answer the question I'm about
yes,
to ask.
yes, in doing this, basically what we need is to have high interest rates. And in having high interest rates, it is not sufficient this time. What possibly will make it to be sufficient is for us to have also higher CRR, and that is negative. Both of them are negative for lending. They are negative for consumers that will borrow. They are negative but for bank customers. But that is what we need to do now to ensure that inflation moderates. It is
Okay,
sadly a sacrifice we have to make.
Let's me come in here now. You have said that it's not a good thing where the banks are not liquid. And at the same time, you're also saying that to address inflation, we need to see we need the monetary policy tools. What about the fiscal policy tools? I remember there was a time that while the central bank or the MPC goes hawkish, on the other hand, there is the fiscal side, there is the development financing, there are other things on the side just to complement and also to strike a balance within the system. So if bank is essentially being starved of cash, I mean, it doesn't even just stop at the CRR or the MPC or the MPR, beg your pardon. We also have, the borrowings. Really, it doesn't seem the CBN is even slowing down its drive to mop up liquidity. It has borrowed so much from the domestic debt market within a short period, and this definitely mops up liquidity. So to what end is it doing all these, and what are these monies for to even start with? I think I asked about two questions there.
So let's take a look at it from this standpoint,
Okay.
right? If you are looking at the the money that the CBN is borrowing, in this case, we are talking about the CBN and not about the federal government of Nigeria. So for the CBN, what you will see them do is to issue OMO bills, and the OMO bills issuance are for the management of liquidity in the financial system. When you allow your financial system to be way too liquid, what will happen is that you are leaving room for inflation to go higher because there will be demand pulled inflation in that regard if you do not control the excess liquidity in the financial system. That is the reason that they sell OMO. If you now ask me what do they use the money for, it is the same money that they rake in via OMO bill issuances that they eventually have to lend to some of the banks. Definitely not all the banks. Some of the banks that will be illiquid, it is the money that they lend to them. Let's take a look at two key numbers. Number one, we take a look at 21%, which is around the discount rate for the 1 year OMO bill issued by the CBN. We'll take a look at the second number, which is 23.75%. That number is the standing lending facility rate. So in that case, you will see that there's a difference of about 2.75%. That is the spread that the CBN will benefit by lending to the banking sector for banks that need to access the SLF window of the CBN. But where did they get the money from? They get it from OMO bill issuances. So that is the reason they have to do OMO in addition to having to mop up excess liquidity. They also need funds that they can lend to banks that are not liquid at some point, so that they will meet their need in that regard. Bear in mind that we also have a situation where a part of that money is sterilized just to ensure that they do not flow excessively into the public to be driving inflation. So those are the reasons that they do OMO bills to mop up excess liquidity.
Okay, so
And
let me
also
just before
how they
we go.
utilize the monies.
Just before we go, let's also add to it the federal government borrowing. I mean, looking at all of these things, I remember the last auction they did at that percentage. Number one, apart from the fact that, it sort of crowds out private investors, we also see a situation where even banks were complaining of liquidity challenges as a result of the auctions and all of the borrowings and all that. So how do we strike a balance at the end of the day?
So we need to strike a balance, and I think the CBN, the federal government, are also monitoring the situation. If we take a look at bond auction for the month of March, for instance, we had an inflow of about 475 billion. At the same time, we had a situation where over 700 billion naira matured in bonds in March. So what it means is that on bond issuance, the federal government had a net negative outflow of cash because the 700 billion that matured is way bigger than the 475 billion that they raked in. So it is a case where the CBN and the federal government have to manage their cash flows. And I think what they have done so far is consistent with the plan in the budget for 2024. It is consistent with what I can regard as an efficient management of cash flow, if you ask me. But in terms of liquidity flows in the banking system, one thing we have to bear in mind is that even one of the members of the MPC committee commented that having excess cash in circulation, having excess currency in circulation is a major risk to inflation outlook. And I believe it is also consistent with what the CBN is doing to ensure that gradually they mop up excess liquidity from the financial system. So I think there is really not need for concern. I think they are on track in that regard.
All right, thank you so much, Tajuddin Ibrahim, Director, Research and Strategy, Chapel Hill, Denham. Thank you for your time, but I guess we're going to have this conversation some other time because there's a lot to talk about. Anyway, thank you.
It's my pleasure.
All right.